Nokia stock is currently trading at $14.89 during today's intraday session, representing a 3.55% increase on a substantial pickup in daily volume. While a casual glance at this move suggests a standard telecom bounce, the underlying narrative is far more interesting. Institutional desks are quietly digesting a freshly announced partnership between Nokia and Indosat Ooredoo Hutchison to build out an artificial intelligence-ready infrastructure in Indonesia, explicitly calling out a joint framework with NVIDIA stock infrastructure. This is not the legacy infrastructure play most retail investors think they are buying. The immediate expectation in the market is that Nokia is a slow-moving cyclical hardware supplier destined to bleed market share to cheaper alternatives. The reality is that big money is actively repricing this asset as a core backbone for global high-performance networking, transforming it from a sleepy value trap into a highly volatile momentum vehicle. When people think about high-performance infrastructure, they naturally crowd into names like Apple stock or look for direct ways to invest online through major tech firms. The general consensus dictates that legacy network providers have missed the boat. Individual brokerage platforms and retail forums recently targeted Nokia, sparking a massive 9% single-day spike that quickly evaporated when short-term traders took profits, driving the stock back down toward the mid-$14 range. This tells us that the tension between short-term sentiment and long-term fundamental reality is tighter than ever. While self-investing enthusiasts on retail platforms try to trade the daily noise, institutional wealth management desks are analyzing the actual hardware backlog. The company's price-to-earnings ratio has ballooned to over 83 times, a stark departure from its historical trading range, signaling that the market is suddenly pricing in premium growth assumptions that the legacy hardware business could never justify on its own. To understand why this price action is so aggressive right now, we have to look closely at the trading volume and the recent sector momentum. Just days before this current bounce, Nokia suffered a punishing 12% drop in a single session, leading the downside among European-American depository receipts. That sell-off was not triggered by a sudden operational failure. Rather, it was a brutal profit-taking reversal after a massive multi-week run from $12.97 up to the $17 mark. When a stock exhibits that level of beta, it ceases to be a defensive dividend play and enters the territory of active momentum trading. Traders utilizing advanced option strategies on an interactive brokerage platform or executing rapid fills via the Robinhood app have completely shifted the stock's liquidity profile. Daily trading volumes have routinely crossed into tens of millions of shares, proving that the asset has become a major battlefield for rotational capital. When broader technology sectors soften, capital frequently uses Nokia as a liquid de-risking vehicle, dragging it down faster than its underlying fundamentals would ever dictate. This brings us to the macroeconomic pressures and the structural shift in how people approach online investment in telecommunications. For a long time, standard online investing advice leaned toward holding boring telecom names for steady yield. If you look at prominent intelligent portfolio platforms or check the asset allocations within a Schwab Intelligent Portfolios account, legacy infrastructure was treated as a bond alternative. Today, macro pressures like high capital costs and shifting corporate budgets have forced a massive divergence in the sector. Companies that fail to tie their hardware to modern computing workloads are being left behind, while Nokia is aggressively attempting to position its optical systems as the literal nervous system for data transmission. This pivot is causing significant tracking friction. When European market indices are flat or green, Nokia has frequently closed in the red, exposing a distinct pattern of relative weakness where large institutional blocks are rotating away from pure-play hardware and searching for deeper security and software integration. If you are looking for investment help or managing an individual brokerage account, navigating these wild swings requires a clear look at what the underlying business actually delivers versus what the headlines promise. At its core, Nokia operates as a massive network equipment vendor. Its primary business model centers on selling mobile infrastructure, IP routing assets, and optical systems to massive telecommunications providers and corporate cloud builders. The older financial reports reveal the massive friction points the business has faced over the last few years. In recent quarters, total revenue contracted significantly, sliding from over $6.2 billion down closer to $4.5 billion as global telecommunications operators paused their traditional capital expenditure cycles. Operating income compressed to double-digit millions during tough quarters, highlighting how vulnerable the company's legacy margins are when global hardware demand softens. Yet despite these structural revenue headwinds, the company maintained an exceptionally strong balance sheet, which gave management the flexibility to issue new senior unsecured notes worth €500 million to fund its high-margin software development. The newest operational development is where the expectation versus reality loop gets incredibly tight. Just today, alongside the network expansion news, the company launched its Deep Field Genome Shield security automation system. This is a direct play to capture corporate software budgets by providing network-wide defense against modern automated cyber threats. Instead of just selling heavy steel antennas and fiber cables, the company is attempting to transition into a recurring software model that operator machine learning systems rely on for clean telemetry. For retail clients managing accounts through Fidelity Investments or looking for solid foundational holdings via Fidelity Mutual Funds, this software transition is the critical metric to watch. If these software solutions scale, they can lift the company's historically modest return on equity out the single digits.
If they fail, the stock remains chained to the low-margin, high-expense reality of heavy hardware manufacturing. Let us look at how this fits into a broader portfolio strategy for a moment. Many independent investors building long-term retirement accounts through Fidelity IRAs or tracking market trends via the Fidelity mobile app tend to look at sector exchange-traded funds such as Fidelity ETFs to gain broad exposure without single-stock risk. When you buy a broad telecom basket, you are inherently buying the average performance of a stagnant industry. Active trading on a modern Fidelity trading platform or managing automated allocations through a SoFi robo-advisor requires isolating the specific companies that are breaking away from industry trends. Nokia's high valuation multiple proves that it is no longer being valued like its stagnant peers. It is being valued on the expectation of a high-margin software recovery. If that recovery materializes, the current price could look like a major fundamental discount. If the revenue contraction continues to drag down the balance sheet, that high multiple will compress rapidly, leaving late-stage buyers holding an incredibly expensive legacy asset. This fundamental tension is exactly why short-term sentiment is whipping the price around so violently. When retail momentum interest surges on applications like the Robinhood app, short-term money floods into Robinhood stock trading features, chasing the immediate intraday swings. These retail inflows often take advantage of Robinhood fractional shares to chase high-flying tech names, but when they rotate into value names like Nokia, they treat it like a short-term trading playground rather than a long-term compounder. The rapid rise of retail cash management and alternative asset classes on these platforms has turned large-cap liquid names into high-velocity instruments. On the other side of the ledger, institutional desks using professional interactive brokers trading tools are looking at deep fundamental indicators, checking the pricing stability of the new euro-denominated bonds, and calculating the exact impact of regional infrastructure modernizations on the company's gross margins. The clash between retail hype and institutional calculation creates a highly inefficient tape where the stock frequently overshoots its fair value in both directions. Comment below how many shares of Nokia you currently hold in your portfolio and whether you are buying this recent bounce or waiting for a deeper pullback. Looking out the future horizon, the path forward for this stock splits into two highly distinct scenarios, both governed by the tension between market narrative and operational reality. In the bullish scenario, the recent string of high-profile international partnerships provides an immediate, highly profitable floor for the hardware business. By embedding its infrastructure directly into modern data projects and securing enterprise clients for its newly launched security suites, the company could successfully stabilize its top-line revenue. This would allow its elevated price-to-earnings ratio to normalize through genuine earnings growth rather than a painful share price correction. This is the outcome long-term investors using platforms like SoFi Invest or setting up strategic allocations via SoFi Active Investing are betting on. They expect that the company's deep financial strength and clean balance sheet will protect them from downside risks while the transition to software infrastructure plays out. Conversely, the bearish scenario cannot be ignored by anyone engaging in serious self-investing. If global telecommunications spending remains depressed due to persistent macroeconomic pressures and high corporate budget costs, the revenue from these new international rollouts may not scale fast enough to offset the decay of the legacy hardware segments. If the market realizes that the current AI-connected infrastructure narrative is moving slower than the stock's massive multiple implies, institutional capital will rotate out of the name just as fast as it rotated in. Traders monitoring the order book on an interactive brokers platform will see institutional liquidations accelerate, forcing the stock to break below key support levels in the mid-$14 range and return to its sleepy value trap origins. This risk is precisely why relying on simple investing sites or chasing social media hype without analyzing the underlying financial statements can be incredibly dangerous for an individual brokerage account. When we cleanly summarize the central insights of this modern market battleground, the contrast between expectation and reality becomes completely transparent. The market expects Nokia to be a relic of a bygone telecommunications landscape, an uninspiring utility stock with capped upside and decaying margins. The reality exposed by recent institutional accumulation, strategic infrastructure deals, and rapid software deployments is that the company is actively transforming its operational profile. It has broken away from its traditional trading patterns to become a high-beta momentum vehicle that demands strict risk management. Whether you are executing a long-term accumulation strategy through Fidelity brokerage accounts or capitalizing on daily price swings using a modern Robinhood investment strategy, you are no longer trading a sleepy dividend stock. You are trading a high-stakes structural transition, where any divergence from hot market expectations will result in immediate, violent volatility.